Hey guys, in today's video we're going to talk about how to properly shop for a mortgage to get the best deal. So here we go. So I realized in my past video where I talked about how people used to shop for rates, and some still do, and how they do it in a way that completely wastes their time and wastes whoever they're talking to on the phone. It got me thinking, why don't we talk about how you can actually get a really good deal and how you should shop for rates and how it actually works in the industry. I can see as a consumer, it makes sense that you want to check out different places and see what they have to offer. But in order to really compare apples to apples now, and that's a term that you hear salespeople say all the time, but is to actually see a specific scenario for specific scenario, you have to submit all your documentation to a company to do a full pre-approval workup on you. Because only then can you really get like a loan estimate. We also call it an LE, but the loan estimate breaks down all of their fees, what they estimate for the third-party fees, what interest rate they're looking at that's not tied to a property, unless you already found a property and now you're shopping at that point. It's all going to be on there. But no one can give you that information unless they've reviewed your stuff. And if they do give you a loan estimate without reviewing your stuff, it doesn't belong to you. It's not really yours. It doesn't make sense. So the reason why you want to actually work with companies and figure this sort of stuff out is it's to your benefit. So you don't think you're getting one thing and then you get something else. Okay, you don't want to worry about like bait and switch. Okay, this is what you said you'd give me, but this is what you're actually giving me. It's like, well, you kind of set yourself up for that if you go into it without giving your information. So first is work with somebody that has a good reputation. So somebody you've been referred to. You talk to someone you know who just bought a house, someone that you trust, and say, who did you use? Do you recommend them? And work with that person. At least reach out to them and get the vibe. See how they're like. See what their personality's like. Start there. If you don't know anyone who's bought a house recently, if you know anyone that's a real estate agent, they're going to have connections to lenders. You can say, hey, who's the person you like to use? Who do you refer out? And then reach out to that person. Okay? So when you're looking to shop for a mortgage and you want to get the best deal, this is kind of what I've seen play out over and over and over again. And it kind of sucks for the loan officer, and I'll tell you why. Most loan officers are paid on a commission basis. Not all of them, but most of them are. Which means all the time they spend networking and building relationships with realtors and other professionals that can refer them business, all the time they spend on the phone talking to clients and trying to get them pre-approved, all the time they take to put a file together and get them pre-approved, all of the escrow period of time once you're actually in a property, they're making $0. They make nothing from all that time. It's only when a loan funds or an escrow closes and the deal is done, will a loan officer actually get paid. So it's kind of retroactive pay for all the work they've put into it. So using this method kind of sucks if you're working with different loan officers who are paid in this way. And that's most direct lenders, brokers. They're almost all going to be paid 100% commission. Now you do run into some loan officers that work for like the bigger banks, that they get a smaller commission cut, but they also get like an hourly wage or a standard salary that basically like floats them unless they're closing deals. But they're usually closing a lot of business. So if you're a mortgage professional out there and you work for one of the big banks like Bank of America, Chase, Wells Fargo, and that's not the case, comment below. Let me know how that is. I've never worked for them. It's just pretty much what I know from hearsay. That's a hawk. They're out here. So to reiterate, why this kind of sucks is, if you go through the whole thing with a lender, you give them all their stuff, they reviewed it all, they said, okay, this is what we can do. You can then take that loan estimate and you could take it to a competing bank or to one of the big banks and say, look, this is what they're offering me. Can you beat it? And what they do is they'll review it and they'll basically try to give you an offer that's better. They'll find out where they can cut. They'll see where they can cut on, maybe the cost of the rate or a better rate or on some of their own in-house fees, whatever the case may be. The next step would then be to get a loan estimate from them. And now at this point, this is how you're supposed to shop for rates. This is how the government thinks you should do it in terms of the disclosures that you get. But it actually is pretty effective because loan estimates are pretty easy to read, especially when they're side by side. They're not like accounting ledgers like they used to be. These forms are a lot easier to read. You're able to actually see side by side what they're showing. Okay. Now, a thing to be aware of when you're shopping is that the lender has to disclose a lot of the title, escrow, recording fees, all this extra stuff that it doesn't belong to the lender. So some lenders will undercut those fees because later on it's plausible deniability. They could say, well, those aren't our fees. We just estimate them and they came out higher. Sorry. You don't want to find out that far down the road that that's what they did. But some lenders do that. They'll just underestimate all the third-party stuff. Now, like I said, the lender's not responsible for that, but they have to have like a good faith estimate of those numbers. It's always been our policy with the people that I work with is to overestimate those figures so that you go into it thinking more of a worst case scenario, and usually you're surprised in a good way that things cost less at the end of the road and not more. Okay, so that's something to be aware of, is third-party fees that don't belong to the lender. They can undercut those, and that's not fair, because you'll see that when they're competing, they just undercut those fees that don't belong to them and say, look how much they're charging for all this stuff. It's like, well, the other person's not charging for that either. They're just more realistic. Okay, that's one thing. But what you can then do, if you like the first lender you were talking to, and I'm talking, this is like the direct lender, the one that only gets paid commission if they close a deal, is you could say, I took your figures to a competitor. This is what they offered. Can you beat it? At that point, the loan officer can usually take it to their corporate office and say, what can we do? And they can usually get you the best deal that they can. And that's usually going to be the best deal that you're going to get. The reason why you don't get offered the best deal right up front is because the loan officer doesn't own the company. The loan officer has to play by certain rules when it comes to how their fees are structured, and they don't have any say in that unless we're competing. When you're competing, it's kind of like game's on and the gloves come off. And a lot of corporations actually like to compete. They don't mind losing out on some profit if they're getting a deal away from a competing bank. So if you're looking, that's where you want to compete. But the only way to realistically compete, it doesn't come from an email you got from another company that just says, yeah, we can do better. It has to come from a legitimate loan estimate, because that's what the corporation is going to look at and say, okay, this is a legitimate counteroffer. We can give you the best deal. And then you can work with the first person you spoke with. That's usually how it plays out. That's how you're usually going to get the best deal. Now, I don't really advocate doing that against direct lenders per se, back and forth, because now you're just kind of using them and they're wasting their time, because now they're going to go through all that work of putting together a file, seeing what they can do just for you to basically use them to get the next deal. And some people do that. And in my opinion, how I feel about it, I don't like that. But if you have like a bigger bank, like a Chase or a Wells Fargo, where maybe they're getting paid an hourly rate, they're making a stock salary, they're still going to get money for their time spent, maybe bounce the ball off against them. But that's typically what I see for people trying to get the best deal, is it usually goes that way. If you talk to someone and then you go to a competitor, the competitor is usually going to win, because you're getting the stock, whatever the company's allowed to provide up front on that first go. The other company's going to see that and undercut it. And it's easy for them to undercut it because they'll see where they can cut, and then they'll just say, okay, we can cut it. And that's usually how that goes. So it's something that I've seen. It's something to kind of tuck under your hat when you're trying to get the best deal you can on a purchase, a refinance transaction. It's kind of a pain in the butt for the loan officer because you're going back and forth, but it's doing it in this way will get you the best deal on there. And so if you saw any value from this video, please like the video, subscribe to the channel if you haven't already. I'm going to keep coming out with kind of inside stuff, things that I've seen and I've experienced in the mortgage industry, and just try to help get this information out there. More people need to know about it so they can see how they can actually get the best deal that they can. Okay? Any questions, comments, leave them below, and I'll catch you guys next time.